Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go. It's generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in. Let's see what people are sharing on social media today. If you want to follow me at Finance, and if you want to join our community, finding-value.com, where I dive deeper into all of these topics, looking for potential investment opportunities. Going into Lance, he says the number of new homes completed and available for sale is at the highest level since 2009. There were 175% more completed new homes for sale in May of 2024 than at the peak of the pandemic housing boom in May of 2022. 25% above pre-pandemic May 2019. So there we are, all the way back. These are at levels slightly higher than the beginning of the last bull market in not just commodities, but also the housing bull market, which was around 2000, 2001, coming through here. But we are going up in terms of new homes completed and available for sale. And I know sales have dipped here for new home sales. This is important because this does generally show that the market is slowing down. As we accumulate more completed homes, and if home sales are dipping, we are getting a slowdown in the housing market. Housing starts have also slowed, showing us that the affordability is having an impact across the board. New home sales decreased to 619,000 annual rate in May. Previous 3 months were revised up sharply. This is where we're at. We're still towards the middle area. We're not exactly breaking out to the upside, but we're also not low, and we're not falling off of a cliff. So we're kind of in the middle, just treading water at this time. Housing is the story, and I'm going over all these housing things. I know some people aren't interested in housing, but this is what drives recessions. It drives slowdowns in the market, and it's important to understand this and gauge where the housing market is going. Employment from the housing market generally leads recessions. So if we see employees declining from the real estate market, we start to see housing starts, home sales of new homes. If they all start to decline, yes, a slowdown is underway and it's coming, and will most likely manifest itself in a downward move in stock prices as well. It says the 2020s decade has already seen more home price appreciation than the total for the 1990s, 2000, and 2010 decades. Through the first 52 months of the 2020 decades, U.S. home prices are up 51%, which beats all the other decades. You can also see the 2000s had a pretty big boom and then the bust after that. So we've been moving on up quite aggressively for home prices in the decade of 2020s. Eric says the months of supply of the U.S. single-family housing market increased to 4.5. 4.5 represents a tight market as broad national price pressures generally appear above 5.5, 6. However, 4.5 is higher than the 2018-2019 average and high enough to have local price pressures. We're coming from very low levels. This is not right in terms of months of supply. This is of the entire work in progress. It's not 9.1 months for new homes. It's actually the one up here, which is not anywhere near what it was in 2007. And this one is showing that we are approaching 2007 levels, which is not correct because they're not completed homes. It's just everything in work in progress. So we're at 4.5, and that's roughly where we were in 98, 99, 2000, 2001. And then we had a large surge in 04, 05. And that's when all the home builders and the stocks rolled over. So that's what we're watching at this time, is all of this information, and we're at 4.5 months of supply for total U.S. single-family housing at this time. Measures of liquidity in the Treasury market continue to send worrying signals with the average yield error approaching 4.5 months. Or I should say 4.5, I don't know if that's months. So this is liquidity is worsening in the Treasury market. And this is the average yield error. So 4.5 is average yield error. I don't exactly know how to read this in terms of, I should say it's outright, average yield error. But if liquidity is tightening like it did in 2010, we're getting similar readings to that as in 2010. Hindenburg omen has just been triggered. This is a major warning signal, and this is the Hindenburg warning signal here of a potential crash. We can see it flashed here before these pullbacks on every single one. And we've got another worrying signal here where we could get a pullback in this in stocks, I should say, or the markets. Traders are betting on a whopping 3 percentage point worth of rate cuts in the next 9 months. Fed swaps price more aggressive cuts than Fed this year. Market continues to price almost 50 basis points of rate cuts by year end. So here's some rate cuts that they have going out looking in 2024, and then all the rate cuts going out 2025 and 2026. We'll see how the rate cuts impact the market. If they lower and do rate cuts, if they lower interest rates, we will see a weakening or declining dollar. That could send certain asset classes upward. And I think that is what's coming. The market is slowing down. We are throwing a lot of slowing signals in the real estate market. We've got this Hindenburg omen, and we also have liquidity drying up in some of these markets, and inventories are going up in the housing market. So things are softening across the board. Implied U.S. oil demand is not weak, so we don't have weakening oil demand. It's still pretty strong in compared to the past 5 years. And this is the 4-week average U.S. implied oil demand for gasoline, distillate, jet fuel, and other oil. Still at pretty high levels. So that isn't weakening at this time. Game of Trade says, alert, trucking employment has been collapsing. This has been a precursor to recession since 1991. You can see the recession, these movements lower, and we are getting a move lower here for trucking employment. So when you ship less things, generally that is an indication of a slowdown when goods are not moving around. Perhaps we're already in a recession and the Federal Reserve is just masking it. They're printing a bunch of money, they're understating inflation, so they can overstate gross domestic product. And if that's the case, we could already be in a recession in real terms. Nominally, we continue to move up because of all the inflation and money printing that the government is doing. They're trying to hide it. But the data underneath is showing us that there are some slowdowns that are occurring. 70% of Treasury issuance in the past year has been Treasury bills. I find this kind of interesting as well. It's almost as if they are trying to manipulate the yield curve here. If you're putting a bunch of Treasury bills on the short end, it holds the interest rates on the short end up. And if they sell and they issue on the, or if we're seeing the long end could move up, and we could also see the short end move up if it's from these Treasury bill issuance, which is keeping the short end of the curve higher. Kevin Gee says, Michael Mabawson explaining to Josh Wolf why he's a big proponent of distinguishing between the process and the outcome. So Josh Wolf says, you're a big proponent of distinguishing between process and outcome. Tell me why. Says this is a really big deal, and it's very relevant concept in anything that has components of both skill and luck. Many of the things we've mentioned, including sports and investing, have large luck components involved. It makes sense for people to look at outcomes. They're objective, and quantifiable, and sometimes they're audited. But of course, if it's probabilistic, you can see cases where a good decision-making process is going to lead to bad outcomes simply because of the role of bad chance. And likewise, and I think more difficult, you can have a bad process that leads to a good outcome. What we do know is that over long periods of time, people who make good decisions process-wise end up doing well, ultimately in outcomes. So the point is, don't dwell too much on the outcomes because you may be looking at noise or luck. Rather, focus a lot on the process because you can be assured in the long haul that people with those good processes are ultimately going to do well. This is a really big lesson that you see across so many different domains. And that's what we have on the website. What I created is a process or strategy. That process is the 3 pillars: ratios, market conditions, and technical analysis. That's what gives us our entry points. That is the process or the strategy. Then you can look to see what the outcomes are of that process or strategy, and then you can refine it, tweak it, move it, however someone likes. And that's the process and strategy that I am deploying. Other people just buy and sell stuff randomly. You don't know if your process is good, if your outcomes, if your process or your strategy is not documented. So you're just getting all of these outputs, and you don't know if you can reliably repeat an outcome. So again, when you have an outcome that is a probability of something over a certain period of time, you have to know that some of these things are not repeatable and some of them are repeatable. Good investors have a repeatable process and a repeatable strategy. Bad investors rely on luck and gambling. The chart below shows the ratio of the Russell 2000 since inception of 1979 to the S&P 100. Over the entire period, both indices are up by nearly identical amounts, with the Russell 2000 even outperforming by a very slight margin. Notice the bottom here. That bottom occurred in 4 of 99. So that was the bottom where commodities outperformed in this leg here. They also outperformed in the 70s as it went up here as well. Then we had an outperformance of the S&P 100. Same with the outperformance of the S&P 100. We're back to very low levels where I would expect potentially commodities or Russell 2000 to start to outperform at some point. The golden age of LNG has begun. Global LNG supply is poised to increase another 35 to 50% by 2030. LNG is now the dominant form of trade in gas. Even if all the Russian pipeline gas would return, LNG would still be a larger market than pipeline gas. These two lines will continue to diverge as most investment flows into creating more LNG supply. So there we are in terms of LNG trade, which is the orange line, and gas pipeline trade could potentially go down a little bit. Bearish breadth divergences remain a tactical challenge. So this is the S&P 500 top and the S&P 500 advanced decline line at the bottom. Bullish confirmation, and then we've got a bearish divergence occurring more recently. Maybe we've got a slowdown and a pullback in the S&P 500. I know we've got a lot of data above that we just went over that is bearish data. So maybe we do have a slowdown that is coming here in the short term. We're also seeing it in the housing market. Who cares about free cash flow yield as long as we talk about AI? So this is the S&P 500 information technology sector, free cash flow yield. You want to have high yields, and that generally indicates a bottom. Then you get your breakdown move, and these, when we get to these low levels, are generally indicative of a top. So you got to be careful here, as the value of technology is quite overvalued with relationship to free cash flow yield. The latest quarter of the U.S. economy data confirms an inflection. The debate is about how strong. So this is U.S. CEO confidence plus 3 months and credit cycle inverted spreads. And we've been going up here to the upside for the U.S. total measure of CEO confidence and the U.S. credit cycle index, both moving up. But are we going to roll over here? People are asking, well, how much further does this thing have to go? That is the question. Hedge funds exposure to cyclical versus defensive sectors is at an all-time low. So cyclicals include consumer discretionary, energy, tech, industrials, and materials, and defensives include healthcare, utilities, and consumer staples. Are we getting a slowdown already as people position into these? And you can see they were very highly positioned in 11, 12, 13, 14, and it's been declining ever since in the cyclicals. So this is hedge fund exposure to cyclical versus defensive sectors is at an all-time low. Conversely, though, if you're at the low down here, this is generally the good time to buy cyclicals because you go from overexposed to cyclicals to underexposed to cyclicals down here. So that's also another thing that you can think about when this does turn and turn around. The Wall Street Journal article on Canadian oil sands. Here's a copy if you don't have a subscription. Forget shale. Canada's oil sands are having their moment. Just to kind of go over this, the American oil patch's poor northern neighbor offers investors stellar returns. They're talking about Canadian oil sands and some of the inflection that's going on over there. Canadian crude export supply and Canadian crude export pipeline capacity going up dramatically from 2020 upward, which means that their pricing will most likely converge to the West Texas Intermediate crude as more takeaway capacity comes online. This is Canadian oil sands operating costs continue to go down, mining and thermal, which is looking pretty good. And that's where we'll end it there for that. Grady says, this looks like a very interesting chart since we know that silver and sugar have a very tight correlation on big picture charts. And sugar has a big falling wedge, a false breakout here in 2024 recently. And maybe we can get a potential breakout of this falling wedge here in the short term. Katusa says, most people have no idea that AI is going to be the single most energy demanding technology on Earth. AI data centers' electricity needs are soaring, soon expected to match the energy usage of 40 million U.S. homes, according to Boston Consulting Group. So global data center CapEx forecast moving on up, hyperscalers, co-location, and we have a big boom in energy demand coming on up from AI. Scott for uranium says how the big names are sitting on the 200-day moving average. Says many big names at major support right on the 200-day moving average, and that's generally been a good time to buy on these 200-day moving averages seen previously. Grady again, just like silver was, platinum is now sitting right below a historical huge blue breakout line. A generational breakout and opportunity is incoming also for platinum. It has now been basing out for about 10 years, just like back before the start of the secular bull market. Back in the 90s. And in 2020, it resumed its secular bull market after a 13-year-long cyclical bear market. The coming blue breakout will confirm resumption of the secular bull market. Also, the blue breakout will mark the start of wave 3, which is the strongest and most profitable bull market phase. So this is what we've got coming up. A big secular bull, second leg, generational breakout opportunities. We had one in 98, 2000, and this is another leg coming here. We've got a bullish MACD also coming on up, looking pretty dang good for platinum. And then we've got the last one here. This is JSG. I've made a simple but material change to my comparative inventory plot, excluding other oils from total stocks, excluding SPR yields an improved fit to the inflation-adjusted WTI versus commercial inventory stocks scatter plot. We've got an R-squared value up to 5%, which is up to 88%. I will be providing this updated plot going forward. When we look here, this is the latest update here. We can see that it's got a big move up, and then we can see that this one is more flat. The reason that it's got this more move, this greater move lower and higher at these outer limits, it's because your days of coverage of inventory is declining. As your days of inventory coverage declines, your sensitivity of pricing withdraws is going to be greater because it's impacting the days of coverage more. So your inventory levels going up and down become more sensitive as your days to coverage go down. Hence, you'll get a larger move up and larger moves down. The sensitivity of pricing, I should say, to deficits and surpluses will be greater. So volatility goes up as your days to coverage go down and your inventory levels are smaller in relationship to days of coverage. But that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. And that's all I've got for today, guys. We'll catch you next time. This is Finding Value.